You've probably heard that becoming a millionaire requires some kind of secret Wall Street knowledge, right? Day trading, picking the next hot stock, staying up all night reading corporate reports. But what if I told you that's just not true? The real path is actually way simpler, a lot less stressful, and it was pioneered decades ago with one revolutionary idea. Stop trying to beat the market and just buy the market. It involves just one or two funds, and the hardest part, having the discipline to pretty much forget about them. Okay, let's dive in.
I mean, this is the story we're all told, isn't it? The whole world of finance just seems designed to be intimidating. You've got experts on TV shouting about micro trends. You hear these crazy stories of people getting rich overnight, and you just assume that to succeed, you have to play that same high-stakes, high-stress game. You have to be glued to your screen, making trades every single day.
Yeah, that is completely and utterly wrong. In fact, for the vast majority of us, trying to act like a professional day trader is probably the single fastest way to lose money, not make it. The real, proven path to wealth isn't built on complexity and stress at all. It's built on simplicity, discipline, and time.
And that's it. That is the core of this entire explainer. Building serious, life-changing wealth doesn't require a finance degree or a secret phone line to Wall Street. It just requires understanding one really powerful concept and then choosing between two incredibly simple options that we're about to break down for you. So let's get into what makes this whole thing possible.
The secret sauce to this whole strategy, the thing that makes it all work, is an amazing financial invention called an index fund. This is what leveled the playing field and allowed everyday people like you and me to invest just like the pros, without having to be one.
So what is it? Well, think of it this way. Instead of trying to find the single best apple in a massive orchard, which is almost impossible, an index fund lets you buy one giant basket that holds a small piece of every single apple. You're no longer betting on one company to succeed, you're betting on the entire orchard, the whole market to grow over time.
And this, right here, is where the magic happens. These 3 points are basically a secret recipe for winning at investing. First up, massive diversification. If one company in your basket goes bankrupt, who cares? You own hundreds, sometimes thousands of others. It's a built-in safety net. Second, they're passively managed. This means you're not paying some expensive Wall Street guru to guess which stocks might go up. And that leads to the knockout punch, ridiculously low fees. Keeping your costs low is the single biggest, most controllable advantage you have in building long-term wealth.
Okay, so now that we get what an index fund is, let's talk about which one to look at. Our first option is a real titan of the American market, a fund with the ticker symbol VOO.
VO is something called an ETF, or an exchange-traded fund. Now, don't let that jargon scare you. Just think of an ETF as an index fund you can buy and sell super easily, just like a single stock. VO's job is to perfectly track something called the S&P 500, which is basically a list of the 500 biggest, most dominant companies in the United States. We're talking about the household names that define our economy: Apple, Microsoft, Amazon, Google. When you buy just one share of VO, you instantly own a tiny slice of all 500 of them.
So why would you do that? Well, because of this number right here. Now, it is crucial to remember that past performance is no guarantee of future results. But historically, through every crash, bubble, and recession you can think of, the S&P 500 has delivered an average annual return of around 10%. Some years it's way up, some years it's down, but over the long haul, it has shown incredible resilience and growth.
And that really sums it all up. Buying VOO isn't just buying a bunch of stocks. It's a fundamental vote of confidence in the future of the American economy. It's a belief that innovation and competition will keep driving these 500 massive companies and the country forward.
So, VOO is a powerful choice, but it's a concentrated bet on just one country. What if you're not so sure the US will always be the world's dominant economic engine? What if the next few decades of explosive growth come from markets in Europe or Asia? Well, that's where our second fund, VT, comes in. If VOO is a bet on America, then VT is a bet on humanity. Seriously, the Vanguard Total World Stock ETF does exactly what its name says. It buys you a tiny piece of pretty much every public company on planet Earth, from the biggest tech firms in the US to rising industrial giants in China, to established banks in Germany. You own it all.
So let's break this down, because this is the core decision. With VOO, you're making a focused bet that the United States is going to continue to lead the world economically. With VT, you're making a much broader bet that the global economy as a whole will keep growing. You don't have to guess which country will win the next decade because you own them all. This is the definition of maximum diversification.
Okay,
So we've laid out the two options, the American powerhouse or the global safety net. So how on earth do you choose? Well, the good news is, for a beginner, the decision path is actually incredibly straightforward.
Here it is boiled down for you. Path number 1 is the one fund solution. If you want the absolute simplest, most diversified, set it and forget it strategy possible, you just buy VT, and you're done. It already includes the US market, so you're covered everywhere. Path number 2 is for the US bull. If you have a really strong conviction that the American economy will continue to outperform the rest of the globe for decades to come, then you can just buy VOO. That's it. No need for 10 different funds. You just need one of these.
And now for the best part. How does this simple choice actually make you a millionaire? The answer isn't some market secret. It's just pure math. It's a force so powerful that Albert Einstein supposedly called it the eighth wonder of the world: compound interest.
The easiest way to wrap your head around compounding is with this really cool trick called the Rule of 72. It's a fantastic mental shortcut. You just divide the number 72 by your expected annual return, and that tells you roughly how many years it'll take for your money to double. So using that historical 10% average from before, your money would double, on average, every 7.2 years.
And check this out. This is how that incredible force works in practice. A single $1,000 investment becomes $2,000, then $4,000, then $8,000, then $16,000. You see what's happening? Your money starts making its own money, and then that money starts making even more money. The growth isn't a straight line. It's a curve that gets steeper and steeper over time.
Now imagine doing that not just once, but every single month. By consistently investing a manageable amount, say $500 a month, into one of these funds, the power of compounding just takes over. Over a 30-year career, that simple, automated action could grow to over $1 million. This is how real wealth is built, not by frantic trading, but by patient, automated investing. That's the real meaning of forgetting about it.
So there you have it, a clear, simple, and historically proven path to building significant wealth that doesn't require you to be a financial genius. The system is designed for you to win if you just let it. The only question left is the one you're looking at right now. The most important step in any journey is always the first one. And in investing, that simply means starting. Not next year, not next month, but now. Even small amounts can begin that compounding process that can literally change your life. If you found this explainer helpful, hit that like button, subscribe, and maybe share it with someone who wants to improve their financial life. Thanks for watching.